Dershlis Horseman here. In this video I'll discuss why I think commodities, real assets and gold in particular, and as well as miners, are truly a generational opportunity right now. First off, this is a commodities divided by S&P 500 ratio, and you can see it, have these wide oscillations over, pretty much decades. So any move here you see is, they're big moves. They play out over years and again decades as well. And lo and behold, I mean, we're obviously in the biggest bubble the world has ever seen, where everything is basically financialized, and the I mean reserve currency of the world, the US. I mean, they've been printing so much paper and running record deficits right now. So basically, I don't think we've ever had, up until now at least, or paper assets and IOUs have never been more highly valued. I mean, the US has been able to basically send out dollars in exchange for real things, from manufacturing items from China and commodities from all over the world for a long period of time now. And the Fed has just kept on printing and lowering interest rates, which is like the price of money, and still the dollar hasn't really taken a big hit yet, although, as we've seen, or as I think many have seen, central banks all over the world have ramped up their gold buying. So it's like it's not like the central banks all over the world, etc., are not cognizant of what's happening. But of course, I mean, the masses, they have no clue. I mean, most people have, most people haven't experienced a gold standard, and it's like with housing prices, when they go up for so long, I mean, people start believing that they can never go down. And I actually see that as, people using that as a reason to buy cryptos and Bitcoin in particular, because for as long as it's been around, it's never, quote, gone down. I mean, when things stay the same for such a long period of time, it's like, it's different this time. Mentality comes into play. And of course, that also leads to, when these shifts actually happen, they're more severe the more, or the longer they've been in one way, let's say. So right now, for example, I mean, again, we've never seen a global bubble this big. Every country is on a fiat standard, basically. Every central bank is printing money. So artificial assets are, probably never been more overvalued from a historical perspective. And what's coming into play now with the sanctions on Russia is that, okay, all of a sudden one realizes that you can't print gas, you can't print oil, you can't print nickel. And you see, commodities across the board ramping higher. Because, I mean, from a risk reward perspective, or game theory perspective, if we just keep going like we've done with the peak of artificial money printing, peak, pulling demand forward, peak in ESG trends, which is the reason why, companies don't even dare to explore for gas or oil in many places, and why it takes, 15 to 20 years now to get a mine running. So it's like, you can't, the politicians can ignore reality, but they can't ignore the effects of ignoring reality. So whereas supply of hard assets, real stuff, in the form of commodities, are being choked, basically. I mean, if you just keep printing money to have the same demand and living standard, and you keep hampering down on the supply, of course that's going to lead to hyperinflation at some point, because there's going to be so much money, and ever increasing amounts of money, they're gonna be chasing fewer and fewer commodities. So it's like, I mean, this is set in stone, I would say. You can't just turn on a gold or copper or nickel mine, tomorrow and fix the supply gap. So let's look at this is another chart. It doesn't go all the way like this, but I think you get the pictures. Like if you catch one of these mean reversions, or I mean the typically, I mean, as you can see here, this was slightly higher than that, and then the low was lower than this low and this low. So it's like if we've gone this far down, I think it's gonna go past mean or median reversion, and I think it's gonna go, highest we've ever seen. Because okay, if we're peak undervalued in commodities, peak overvalued in artificial assets, I think we're gonna reach a peak when the time is to actually sell your gold, silver, etc. And that's gonna be when real assets are peak valuable and perhaps even overvalued, and artificial assets are perhaps almost gone, or at least undervalued, let's say. But obviously we're far away from that point in time. And just look at some inventories versus price here. This is copper. Here you can see the inventories. They're near, I think this is the 2008-9 bottom. So inventories are below the lowest level in 15 years or so. And what is interesting is that price started ramping here, but typically, I mean, if you see from the bottom here, price ramped, and I mean the trend was also up in terms of inventories. But now we have pretty much record low inventories, and we've been around record low inventories, and the price of copper is just kept on going up. So it's obviously that something appears to be quite different this time around. And I mean, I would say that's good from a copper owner perspective, because obviously one of the risks why I like gold and silver more than commodities overall, even though these are obviously consumed commodities, whereas gold and silver, etc., almost all gold is still in existence, which could be brought onto the market. And I think it's 50-50 with silver, somewhere around that, in terms of what goes to investing, which is stored away, and what goes into products and being consumed in solar panels, etc. So you don't have the same kind of, I mean, the nickel is gone basically because it's being consumed, and you can just recycle everything tomorrow. But you could put on thousands of tons of gold on the market if inventories at the exchanges are low. So that's obviously better for the broad-based commodities, but at the same time, higher prices tend to crush demand. And like we saw in 2008, 2009, copper, oil went up to $150 per barrel, crushing the economy, and then went down to some, $25 a few years later, something like that. Gold obviously didn't do that. I mean, it got margin calls, etc., but it typically never goes down more than 50%. So whereas rising price can crush the global demand, obviously, if it gets more expensive to create or build stuff that requires copper, it's not the same thing with gold and silver from a monetary perspective. And given where we are right now, I mean, I would think that, I mean, I see some people who argue that, I mean, the US is already in a recession, China is looking, there's been some negative headlines out of China, let's just put it like that. So I mean, we might be close to a global recession, and then one has to think, okay, what's going to happen with the demand for copper, nickel, and whatever if we if we go into a global recession, and also many of these, let's say, trends that benefit copper and other green metals, they're based on ESG, global warming, etc. So what happens if that narrative changes? Will that will we ease off on the pedal towards going green, which could be a systemic decrease in demand, let's say. Not that it might be enough to actually slow demand that much, but a bit less on the gas pedal, let's say. And here we have zinc. Not exactly the same thing, but I mean prices have gone up, and inventories are still going down. So I mean it's good for a zinc bull, obviously. And we kind of saw the same thing here, and then it peaked for a while and then actually went down with inventories. But here they move together. Here they at least move together. Here they start to diverge. But right now it's looking a bit like this, and I don't know really what conclusions to draw other than that it doesn't look. It's the opposite of what it looked like in 2008-9 and going out of 2008-9. So I think that's a bullish thing for zinc. Tin has been on an absolute tear, and you see, I mean, the inventories are bouncing at pretty much record low levels, and price, even though it's gone up, there doesn't seem to be a lot of supply coming into the warehouses anyway. So it appears that, I mean, this is really tight supply. That everything that comes in basically gets gets taken from the exchanges immediately, regardless of the higher in price. So it doesn't seem to be crushing supply or demand that much, at least so far, and I think that's quite bullish, obviously. So this looks like the strongest one. I mean, it's not that. I mean, anytime I see, I prefer to buy low, obviously, but if you just look at the fundamentals here, I mean, here we had a vertical rise as well, but here you also had at least or these were inventories, forgive me. So it's a complete opposite picture. Here is when supplies inventory ramped higher while price went down. Here we have a rising price, but inventories aren't going up. So again, I think it's just paints the picture that there's a severe shortage in tin, and the demand is still there even with a rising price. And again, tin is quite rare, and there's not that many. I don't know. I don't think there's many tin mines coming online soon. Of course, there's a bunch of tin coming from artisanal miners, etc., which could, make up for it. And again, what happens if we go into a true global recession? I don't know. It's just that this is quite a bullish picture right now. And of course, I mean, if price goes down, demand goes down, there still won't be magically a lot. I mean, that will reduce supply for a while, at least from artisanal miners, I would say. Lead, kind of the same picture actually. I mean, down to 2008-9 levels in terms of inventory, and price is going higher while there still isn't more lead going into the warehouses. It seems a bullish supply demand picture. Aluminum, same thing. Yeah, looking like tin pretty much. I mean, again, it's like totally exponential rise in price, and still everything gets jacked off the exchanges. So appears to be a severe supply shortage, which I mean is basically the whole theme. They're simply due to ESG trends and need for green metals or whatever, and a growing world economy. Commodities are simply in supply shortage as across the board right now. So I if there was ever a time to own real assets, that would be now, I think, and this is a good one. since I'm again even more bullish on gold, pretty much let's say discoveries for gold since 1990, and this is the gold exploration budgets. Peaked in 2011, but you can see a clear trend down, even though exploration levels are higher than they were in this period of time, but they found a lot more ounces. I think we take up around 90 million ounces of gold a year, and we find like 45 million ounces or something like that. So again, even with gold, although with that said, yes, all gold that is basically has been mined in history, most of it is still out there somewhere and could get onto the market. But in terms of mining, etc., and demand for new supply, we're simply mining a lot more than we're finding. So that's obviously going to be a pressure upwards in terms of price, and that might get that gap might get filled by existing supplies above ground, of course. But again, take it into the context of the world we're seeing. Okay, commodities are in short supply. Artificial assets and fiat basically is in a decline, and they're printing just more and more. So at some point in time, countries obviously will want to get something real in exchange for giving away something real. So if you are a copper exporting country like Chile, let's say, you produce more copper than you need, but you don't have, let's say, nickel or oil. So okay, in that case, you might not be accepting fiat anymore in the same degree that you used to, and then you need stuff you don't have, and you're willing to send away copper in exchange for that. But I mean the country, let's say, that has the nickel or oil or gas or whatever might not need that much copper. So I mean that's where gold comes into the picture as basically the store of value and the hardest form of money. So that's gonna, if you sell copper and get gold, then you can use the gold and buy the commodities you do need, etc. So that's why I like the universal value of gold, because okay, I'm not. I mean, it's hard first of all to store a bunch of copper. But at the same time, it's the hardest form of money. So if the fiat system implodes, gold's gonna be the linchpin anyway, and I think it's gonna be, increasingly the linchpin of trade in commodities between China and Russia, etc. So when again, it's like I prefer to be somewhat right than 100% wrong, meaning that okay, if I like real assets, and if I were 100% in copper, it's like okay, but what would happen in a global recession, etc., that takes down the financial system? Then I think copper is gonna be more valuable than your money, the money you had in your bank account. But at that stage, I think gold is gonna be revalued big time, and again backstop the trade. Let's say, I mean, when we go back to a semi or a quasi border system. And I mean, in terms of risk reward, I think it's again a no-brainer. I mean, look at the valuations in the broader stock market. This is the US stock market, I would assume. Historically, incredibly overvalued. So that's what I mean, I wouldn't say get, because most people aren't aware just how good the opportunity, that it is a generational opportunity in the commodity space and the mining space. Because otherwise, it's like, how can you justify buying, let's say, Apple? I don't know what the PE is, but like you buy it at PE of 25, let's say, which is not even cheap to begin with, especially given the size of Apple. So I mean, how easy is it gonna be for Apple to double? Where and at the same time, how much downside is there if we go into a global recession, or some competitors come online or whatever that kind of offsets demand? I mean, it's like I don't want to be guessing buying Apple at 25 p and just hoping that, well, I think my analysis tells me that it should be trading at a p of 32 or whatever. It's like, you're chasing, let's say, 20% of real upside or 30% of real upside in a 2 year period. Whereas in the juniors, especially, and minors overall, you're looking at, okay, generational generationally undervalued levels, whereas like a mean reversion should have them up, 200-300% easy. And if we go into a full-blown gold bull or and mining bull, I mean, I expect 10 baggers from a lot of these. I mean, how in the stock market, I mean, again, it's like the risks are to the downside, especially in real terms, and the upside is pretty much muted if you look at this indicator, and not even the recent fall really took away much of the downside. I mean, there's a far, there's some distance left to where it historically has turned and bottomed. So I mean, I don't own a single broad, general stock basically, and I'm not saying that's the best way to go about it, because okay, diversification is always good. I mean, especially depending on your situation in life. And again, it's like to put everything in one trade is also risk, obviously, because there are risks we have no idea about. I mean, let's say, for example, there's one gold stock that's like far superior than every other stock. I still wouldn't go all in on that stock, because if God forbid the worst thing happens for that company, whatever reason, might not, probably a risk one might not be too aware of, and you end up in a dying fiat system, and you got everything in all of your money piled into something that gets taken away from you, or drops to zero, for example. I mean, I rather be somewhat right given the magnitude of what a mean reversion here would look like, than be 100%, and risk being 100% wrong and putting all my eggs in one basket. So I'm more diversified in terms of jurisdictions and companies. I own some, nickel, some rare earths. I own some base metal plays, a lot thanks to the incredible demand supply picture you can see in these charts. I mean, for example, Eluro, which has perhaps one of the largest tin discoveries in a generation. I'm all for that, especially at these prices. So it's like that's a no-brainer, even though it's not gold focused, but they have I think they're gonna have hundreds of millions of ounces of silver as well, so I get that added benefit, and silver is actually cheap and down, whereas tin is high, so I get some internal diversification there as well, and they have zinc and lead as well. So that's what I like. I mean, again, it's not a one-trick pony, so even though I think gold has the best, let's say, risk reward and less volatility than most other commodities, I can't ignore a good case, and I can't ignore the supply demand picture in the base metals, etc. This is a very interesting chart in my opinion. This basically sums up my case why I don't own a single large cap miner. Obviously you would I mean, having bought Newmont here, obviously a good thing, but I'm not after perfection. I'm after the best risk reward, and typically juniors are obviously more volatile. I mean, they move way more than the majors, and they get destroyed more than the majors. So I mean, they can reach absolutely ridiculous levels, and they are typically a bit slower to revalue. So I mean, I consider my portfolio to be kind of back end heavy, let's say, because okay, obviously Newmont, largest gold miner in the world, that's at or near all-time highs already. whereas this is the short of strategic metals, which is a prospect generator, and I'm using this as a sentiment indicator and basically a value or price proxy for the junior mining sector. So we can see when we reached a sentiment peak, it reached this level, and then it reached this level again, whereas Newmont actually made higher highs, etc. So I think this is suggesting that the general funds, etc., are moving into the gold mining sector, and of course they're not going to be buying the juniors where they can move the price 10% with a $10,000 purchase. They have no first of all, they probably aren't allowed to buy juniors, and they can't really buy in the open market. So this is where obviously the playground is for the retail people, and they're nowhere to be seen yet. Gold is obviously almost close to all-time highs. Gold miners, larger miners, they've been doing quite well recently, and they also, they are a proxy of the actual value of the gold business, the value of going out and exploring for gold in hopes to find future supply. So that's how I see it. This is the product. So the juniors aren't catching up with the very thing that they're actually looking for, which doesn't make much sense. And they've underperformed price of gold wildly. And this is basically a proxy of the value of the gold business, especially the good gold businesses. So the juniors are of course the future supply and future gold businesses. So they're at near multi-year lows at a time where again it's like where the supply picture for gold is increasingly favorable. We're not finding that much new supply, and we're mining much more than we're discovering. And then you have again this, we haven't even begun the mean reversion. So this is the juniors right now, especially in the gold juniors, because price of gold is so high, and I think that goes for a lot of base metal plays as well. Whereas tin, for example, is at all-time high, and I think that's one big reason why I think Elori is incredibly cheap right now. But at the same time, when you factor in the risks, let's say, to base metals, that okay, if we go into a global recession, etc., if fiat starts to die, if the bond markets start to tank, because it makes no sense to buy a bond that's throwing off 1% if inflation is 9%. It's just destroying money. So one day that all those trillions of dollars are probably going to flee into hard assets, and that's, I would guess, primarily goes into gold, not copper or tin or nickel, etc. So when you account for that, the risk reward in the underlying commodity from a, let's say, business cycle standpoint, I think again it's like ridiculous. It's easily the best opportunity in juniors we've probably seen in decades. So it's like there's today we see a gold slam. It's like not even close to thinking of selling anything, because I'm not. I have never been more comfortable with a trade, because the risk reward is just so obscene. The juniors should already be up around, let's say, 200% on average, at least for the decent to high quality juniors, and they're not. So it's like, I think there's an easy 200% upside just to go back to somewhere that could resemble fair value, and then we have the favorable picture for gold in terms of this. If gold juniors are 200% undervalued relative to where in light of where this chart is right here, imagine how much upside there is beyond that. So yeah, no, absolute no-brainer. And again, it's like, yes, base metals, etc., they are consumables. So and that's not the same case for gold. But again, it's like when if we go into a global recession and the bond market starts tanking, etc. I mean, there's not too many places to go for trillions of dollars, and I think, I mean, I expect uh, we will see the mother of all bull markets in real assets, commodities, and especially gold and silver going forward. And that might take months or years, but it doesn't matter. I mean, if you would be happy, you would beat the market handedly if you could average 200% in 3 years. So it's like you only need common sense and patience, because there's so much risk-adjusted free money on the table right now, and if you have the patience, I think you're going to be up hundreds of percent in a well-diversified mining portfolio in the next 2 years, and you can't ask for more than that. But most people are greedy that okay, they want immediate gratification, so they're not, they're I mean, there's a bunch of people probably selling because, well, these stocks don't move yet. I mean, uh, that's just impatient greed basically, because again, this is going to be hard to turn, because this is the end of a 40-year uh, hegemony of the dollar. So I mean, when that's going to take a lot to kill or unwind. But when it starts to unwind, I mean, that you're probably going to see valuations, etc., and charts in real assets and miners that you can just dream of right now. And then, of course, I mean, everyone has to be cognizant of the fact that yes, there's obviously a risk of nationalization, semi-nationalization, and what they're gonna do when everything implodes, because we know that the politicians, etc., change the rules based on the median voter, and the median voter isn't, for better or for worse, long gold yet, or hard assets. So just interesting. I did a piece on titled "Confiscations and Gold Miners." Because again, it's like I don't want to be right on the trade in terms of, yes, gold rockets up, and let's say miners start to rocket up, or have rocketed up, and then everything gets taken away from you, let's say. Because then you'll be 100% right but get 100% the wrong return. Well, not 100% the wrong return, because it might actually, it's like, okay, if the worst case is that you're no better off with owning gold miners pretty much than money in the bank, then it's like, okay, the downside risk is moot point basically, but you have the upside risk in terms of if every unit doesn't get confiscated. But on that point, here's homestake mining and the Dow Jones Index, as well as some important dates here. So March 5, 1933, President Roosevelt confiscates gold. This is for the US, obviously. So we obviously, homestake mining had bottomed here and was on an upward trajectory, and then here Roosevelt basically confiscates people's gold coins, etc. But as you can see, and then he revalued it from $20 to 35. So okay, they take away your gold here, most of your gold. I mean, I think again, physical, you should own. I mean, that's the basis. I see physical gold and silver as a hedge to my mining portfolio, because that's still risk on, because there's business risk involved, etc. But even in this case, okay, they confiscated gold, but I mean, and then they revalued gold higher. But if you held on to miners, I mean, they didn't nationalize all the miners, but I guess they became the, let's say, exclusive buyer of the miners' products. So that's what I like about owning both physical and miners, because sure, they can, let's say they nationalize or confiscate physical gold. Well, okay, the value of the gold business will be increasingly high at that point in time, and I don't think there's a lot of countries that could nationalize everything. I'm thinking, okay, Western Australia and Canada, for example, where the resource sector is so large. I mean, is the state gonna just nationalize everything? No, but I don't think so. But maybe they could, nationalize the output of the gold miners. But if you own the gold miners, you're selling directly to the governments, for example. Then you'll be the owner of, an exclusive supplier to the government. So that's what I really like about owning both, and why I'm kind of chill about it. Uh, and of course, I like, that's also why I like, being diversified right now, because if juniors across the board are so cheap, you're not giving away much in terms of upside. Sure, there are gonna be, let's say, there are 50 juniors who have an expected future return of 200%, and you have 3 juniors with an expected future return of 350%. I mean, if you didn't care or consider jurisdictional risk or diversification, whatever, you would only be in those 3 juniors. But let's say they were all also only centered in one jurisdiction, whatever. Then you open yourself up to, jurisdictional, concentrated jurisdictional risk. So I rather be diversified and have a high probability of getting a 200% return than being overly greedy. Put most of my, a few eggs only in the basket, and risk being stuffed basically by, a government. So I believe, I mean, I'm more diversified than ever, and I think, I mean, I own companies across commodities, different commodities. I own companies in different jurisdictions. I'm in Africa, Latin America, Sweden, Finland, North America, obviously like Nevada, British Columbia in Canada, Western Australia, Eastern Australia, etc. So, I mean, since if you combine the fact how undervalued the units are right now, with the fact that it's commodities are, and real assets are, record undervalued, and you factor in the supply demand picture for gold, then you wouldn't, I mean, even if some stores go south, and even if some stores get nationalized, I mean, there's going to be some stores that go up like, 20-fold, I think, easily. If you hold them long enough, if you hold them for 5 years, I think there's for sure going to be some 20 baggers. So I mean, that's going to pay for 19 other stores, assuming the same position size, that went to zero, and then you would be even. But let's say you only, let's say 5 out of 20 do become a 10 to 20 bagger. That's going to offset the rest big time. So that's what I really like as well. Because again, it's like, I don't want to miss this. I don't want to be too greedy and miss this by, owning one company, or being in only one jurisdiction, because this is such a generational shift that you can catch, a fraction of this move in some way, shape, or form, and you're probably going to do better than 95% of the people. And what I find, poetic perhaps, is like, this is a long-term short for Newmont Gold Corp. We had a peak in 1987 here, and recently we touched pretty much the exact high. Okay, so that's like, I mean, one could say then this is like 35 years of consolidation. And if you look at the RSI, I like to look at RSI. We made it broke out big time here from again almost a 35-year RSI resistance line, and it is basically bounced on the support line. So I mean, I would expect, if when this breaks, that would signal a, let's say multi-month or multi-year downtrend. But at the same time, this is such a huge break to the upside that I think a generational shift has happened. So again, combine these two. Here you have appears to be at the bottoming end of real assets being most undervalued ever in history, and at the same time you have the largest gold miner in the world that's at the cusp of breaking a 35-year resistance line and 35-year consolidation pattern, while it has already made a, let's say, 33-year break of an RSI line. So I mean, to me, these two things rhyme, because this signals that, okay, if we go up above here, that's gonna be, all hell is gonna be breaking loose. The adage, the what is the saying? The longer the something along the lines like the longer the consolidation, the higher in space. So I mean, imagine what this would suggest if this breaks where Newmont Gold is going, and it just again happens to coincide with, like, okay, this would be the most largest generational shift into real assets that we perhaps have ever seen. So I think these two pictures rhyme with each other, and that's why I think it's increasingly believable that I mean, this is for sure gonna turn. I mean, that's just, there's no other way about it, because you see the state of the world. Real assets are gonna get revalued big time when the fiat bubble implodes. So okay, if you know not when, but that it is gonna go higher, what do you think? Do you think this is gonna break lower or up or down? I think up. So okay, then that would trigger a breakout from a 35-year long consolidation. So it's like, when I see people selling right now, let's say they get out of juniors, whatever, because gold is down 2% or some bullshit headline, whatever. It's like, talk about missing the big picture. It doesn't get bigger than this, and that hasn't yet begun. So it's like, I've been buying gold, silver, and gold and silver miners since 2015. Basically around here, just to front run this. That's why I've been, buying every month basically, and been pretty much 100% long, because I mean, we haven't even begun the move yet. So I'm just front running the monumental shift and adding and buying as much real assets as I can in time for stuff like this to break. We haven't seen anything yet. There's gonna be, I mean, if we're looking at gold, up up or down 1-2%, I think we're gonna see moves that we can't really believe right now. And when again the US, when that cracks, when the US dollar cracks, etc., that's forget about. I mean, when I see people expecting gold to go up, like, it's gonna go up to $3,000 within 5 years, it's like, I think that's a linear thinking. It doesn't, I don't think it accounts for this being a, let's say, regime shift, a totally new era. So it's not like, it's just projecting, the status quo basically, that yes, COMEX and silver will keep working like they've always done and we'll have a steady trend. No, I think that we're at the end of the great fiat experiment, and when that breaks and dies, there's going to be a new era, and you can throw out the textbook of how things traded before that, especially as it pertains to real versus artificial assets. And it's like, yeah, some people are starting to wake up. I mean, Elon Musk has 88 million followers on Twitter, and he's starting to talk about inflation and urging people to, I mean, the people who own Tesla are probably not the ones that own gold. So if the masses start to wake up about, there's ways to protect, and again, most people haven't even seen a gold standard or a, down or a rise in rates, for example. I mean, there's been a bull market in bonds for the last 30 years. So again, monumental shifts are happening, and when the masses come in, I mean, in some juniors right now, I'm like the only buyer. So it can't get, can't get less buying than that. So when the glass is already empty, there's only one way that can change in terms of state, and that's for the glass to get fuller. So if there's no buyer out there, it can only, by definition, get better. I mean, it's an oversimplification, of course, but it's like, again, don't even. I think it's you should pay no attention to the daily gyrations now. I mean, this is, and you see, I mean that's 1.3% on some bullshit headlines, and your market's up 1% for some reason, and they're already, at near record valuation. So this is the most obvious no-brainer I've ever seen, and I don't care if it takes 1 or 2 years more for the mean reversion to really get going, or for Newmont to break out of this. Might go something like this, because I mean, again, the market averages 9%, around 8-9% per year over the long term. I mean, even if Newmont, I don't own Newmont, but use this as a proxy, even if it goes something like this, let's say you have a 1 year downtrend, and then it goes something like, this. I mean, if you bought here and just sat through, you're gonna be killing everyone else's returns anyway. Because I mean, if it goes like this in real terms, imagine what it goes in nominal terms, etc. So I'm patient. I think. I mean, I don't think it's wise to change horses when the payday is of this magnitude. And if you can't hold something because it if it doesn't go up within the next week or month, it's like, yeah, you're never gonna make serious money. Because again, these shifts, these trends, these are multi-year trends, even decades. So I mean, I'm buying the juniors I'm buying right now, for example, are the ones I think will go up, 200+% within the next 2 years. So I'm greedy about company X in 2 years relative to where it's priced today. If gold goes down 1%, nothing has changed for the company. It doesn't take away anything really. I mean, the fundamentals don't change like that, and most of these projects won't be mines in 5, 10, 15 years anyway. So it's almost a moot point, and shouldn't really, I think, come in as a factor. So again, it's like I'm super greedy now because I know that in a year or two, I think I'll be sitting on a double. And beyond that, I mean, I'm open for some of these stories to become 10 to 20 baggers, but that's probably gonna take, let's say within 5 years, I think a lot of them are gonna be 10 to 20 baggers. If that should make you greedy enough to have the patience to, like, yes, okay, I understand I can't beat the risk reward. There's no better place to be, and I don't care what the short term is, because if I just hold it for 2 years, I would expect a 200% return. If I hold for 5, that's when the monumental shift should have be ongoing for real, and I could be sitting at 10 to 20%, and those kind of returns. I mean, you could. Many people could probably retire on that, and at least it's going to beat the overall market returns by orders of magnitude. Because again, it's like you should be happy. Most people don't even beat an index, and if the index returns 8 to 9% per year, so I mean, how long would you in reality, from a rational standpoint, be willing to wait for 200%? That's many years. For a 10 to 20 bagger, that's like a decade, or more than a decade. So it's like, I think the worst time to be impatient is now. I think common sense and patience is uh, at peak value right now, and I don't think it's wise to look at the short term. I mean, again, it's like most of my miners right now. I don't think they are sells before, if at this gold price, before they at least go up 100 200%. So it's no point in me actually looking at the portfolio, because they're, unless there's any news out, they're still undervalued by 100 200%. So I haven't done a lot of trading at all for the last year or so, because there's nothing that's really expensive and everything is cheap. So I'm just buying across the board. But again, it's like diversify. Don't put all your eggs in one basket, I think. And all companies I mentioned, or not the big ones, but like Eloro, for example, they're a banner sponsor. I own shares, so it consider me biased. And also, it's like you don't. I mean, I have my favorites. You don't even need to have the same favorites. I think again, just being in the sector right now is the smartest choice. And if you, the less you know, the more diversified you should be, because again, this kind of move, this kind of rising tide, that's going to lift everything. Yeah, thanks for listening, and subscribe if you like my content. Thanks.